US Treasury yields in the US dollar are higher as traders pare back bets the Fed will cut in June. Japan's Nikkei has closed up over 2.5% as traders expect a dovish hike from the Bank of Japan later today. And the RBA is expected to hold today, but retain a tightening bias for now. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior economist Miles Workman says New Zealand is at risk of a credit rating downgrade because of a high current account deficit.
New Zealand still does remain quite vulnerable via sovereign credit rating agencies, for example, just regarding our external position, which has become very imbalanced in the post-COVID era, partly because we've had an overstimulated economy, which sucked in a whole lot of imports.
But first, in 5 and 5 with ANZ, US Treasury yields rose 2 to 3 basis points overnight as traders reduced their bets of a June rate cut to seeing less than a 50% chance. A slightly firmer US dollar saw the Aussie down 0.1% at 65.55 US cents and the Kiwi flat at 60.80 US cents at 5 a.m. Sydney-Melbourne time. The key for the Aussie will be the RBA's decision at 2:30 p.m. local time and ahead of the Bank of Japan's live decision tonight. In global stock markets, the Nasdaq's up about 1% on a report that Google's Gemini AI will be used in the iPhone. Japan's Nikkei closed up over 2.5% on hopes the expected hike today by the Bank of Japan will still leave monetary policy relatively loose. Number 2, the Bank of Japan is widely expected to end 8 years of negative interest rates later today, hiking for the first time since 2007. A 10 basis point hike to 0.0% is expected. ANZ international economist Tom Kenny describes the move as symbolic, and the rate hike might not be the end of it. He says the BOJ may scrap its yield curve control program of bond buying, which would see the bank buy fewer bonds than are maturing.
So in a net sense, the Bank of Japan's balance sheet will be shrinking. So that in effect, it's going to be modest quantitative tightening going on there. In addition, there's some guidance in their statement which suggests that they're prepared to ease rates if necessary. We think that that particular statement should be removed given that they're moving towards a tightening position, albeit still highly accommodative monetary policy. And the Bank of Japan also has asset purchase programs where it's been buying ETFs and J-REITs, and they haven't been that active in those markets for a while. We expect that they will probably cease those programs as well.
Number 3, although a hike from the Bank of Japan would be historic, markets are ready and have already priced it in after strong wage growth figures on Friday and reports over the weekend that a hike was likely. ANZ head of FX research, Marjabeen Zaman, says other factors may actually drive the dollar-yen more today.
The expectation for a potential hike this week may largely be priced into the dollar-yen. And interestingly, dollar-yen has actually moved higher and yen is weakening. At the end of the day, it does seem like the bottom line for this currency pair is rather linked to what the US yields do rather than what Japan does. And what we have seen for US yields over the past couple of weeks is that they've only been moving higher ahead of the FOMC meeting this week. So while, if we do get a shift on this today, we may see a marginally stronger yen on the announcement.
Number 4, the Reserve Bank of Australia is expected to leave its cash rate on hold at 4.35% at 2:30 Australian time today. ANZ's head of Australian economics, Adam Boyton, says the focus will be on just how much of a tightening bias remains.
I think they will have that tightening bias in the statement, and it'll be, fairly similar to what we saw at the last meeting where the statement said, quote, a further increase in interest rates cannot be ruled out, end quote. I just don't think the Reserve Bank and the Reserve Bank Board will have seen enough yet to push them off that tightening bias. But by the time we get to the May meeting, I think that bias will be gone and the bank will be at neutral.
Number 5, industrial production and capital investment data from China yesterday for January and February was better than expected, says ANZ China senior strategist Zhao Pangjing. although those numbers were flattered by a low base a year ago.
Remember last year, from January to February, most of the activities remain subdued by the pandemic. So I think the low base last year helped the data. Going forward, we expect the growth rate of major activities will decline. So that I think it's not a sustainable growth momentum to China. China government need more support in the future to have a sustained growth momentum.
Xiaopengxing there. Now, in today's bonus deep dive interview, ANZ New Zealand senior economist Miles Workman looks at how New Zealand's largest export, tourism, is still not back at its pre-COVID levels, and the effect that is having on the country's current account deficit, to be released tomorrow.
We've penciled in a further narrowing of the annual deficit, so that's from 7.6% of GDP to 7.1% of GDP. So fair to say there is some progress happening. But the big picture story here is, a current account deficit with a 7 handle or even a 6 handle if we get a positive surprise on the day, it's still far too wide to call sustainable. New Zealand still does remain quite vulnerable via sovereign credit rating agencies, for example, just regarding our external position, which has become very imbalanced in the post-COVID era, partly because we've had an overstimulated economy, which sucked in a whole lot of imports. That is unwinding now, but it's happening quite gradually, and also partly because we shut off our largest export earner, which is international tourism, and that's back at about 80% of its pre-pandemic capacity at the moment in terms of the number of people in New Zealand. So we are moving in the right direction, and that current account deficit is certainly narrowing, but we're still not in the safe zone yet. We're still too wide to call sustainable.
So do you see tourism continuing to rebound, or is it going to tread water for a while?
For the tourism industry, I think for us to get back to a real sense of normality, we do need to see China back into the equation. And so far, visitor arrivals from China are still well down versus their pre-pandemic levels. So if we're thinking about different markets, the biggest recovery that we have seen has been from the US, but the weakest recovery has been from China. And to get back to normal levels, we'd want to see that demand in China pick up. But, things are looking a bit softer under the hood there. And, that is affecting their appetite to travel and, of course, spend overseas. So it could be a bit of a long haul for the recovery overall for New Zealand tourism. We could be a few years away, in fact, from breaching pre-COVID levels.
So as that plays out, though, how narrow can the current account really get if tourism's not coming back fully?
Ultimately, if tourism exports don't pick up, it just means for us to get the current account back into a more sustainable position, something else is going to have to pick up the slack. So you could do that with domestic demand, basically hit households with higher interest rates or a sharper fiscal consolidation, for example, which would mean less domestic demand and less imports, and would have an improvement in the goods balance. Or you could do it with some nasty assessment of New Zealand's sustainability, which ultimately affects our risk premium and our exchange rate, which would therefore basically make our exports more competitive in global markets and cause an exports-led recovery that way, for example, if the exchange rate was to depreciate significantly. But ultimately, there is certainly no such thing as a free lunch here when it comes to getting New Zealand back on a sustainable trajectory. And unfortunately, the path forward does involve a bit more sort of belt tightening, and that's belt tightening from both the private and public sectors.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, March the 19th. Catch you tomorrow with all the reaction to the decisions by the RBA and the Bank of Japan. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.